Well, don't know if you guys are hearing this, but I'm starting to hear everywhere that 2023 is going to be a terrible year for stocks. I mean, if this year sucked, next year with a recession and everything else coming probably means it's going to be a lot worse than this year in the stock market. And now I'm also hearing some say the market is still overvalued and was way more overvalued than the tech bubble, which of course means there's a ton of pain to come. So I ran across a video that discusses exactly this, and guess what? There were actually a lot of great points in this video that I agree with. And you guys know I give you the truth, so there's no sugarcoating here, guys. That's exactly what I saw. You guys deserve that, so that's exactly what I'm going to give you. And all I want for Christmas is a gentle tap of the like button. And for everyone who watches me, someone regularly at least if you enjoy the video, go ahead and subscribe too. I mean, it really helps out the channel a ton. So thank you very much for those of you guys that are subscribed, and for just newly subscribed, thank you guys too. All right, so let's jump into this video.
Joining us now to discuss, we've got Matt Maley, Miller and Tabak & Co. Chief Market Strategist. Matt, great to have you here. All right, with the time that we have left in 2022, which has been a wild year to say the least, are we really expecting there to be kind of any strength to a year-end rally here?
Well, we certainly could have one. I mean, you always have that, fear of missing out type of thing, especially for the institutional players. This has been a really tough year. And if you're a portfolio manager, even if you've been keeping up with the market or even outperforming the market, it's been a tough year, right? You're outperforming, you're still down in most cases. And if the market rallies into the end of the year and finishes better and you're sitting on a lot of cash, you're going to look silly. So they will have to. There
you go. You kind of heard it right there. Remember, these guys are traders, these big Wall Street guys. And you just don't want to be the guy that doesn't, basically, take some gains or, have money invested to kind of get, kind of catch on that end of the year run, or else you end up looking silly compared to your competitors. But just remember, they're traders, and that's exactly what they're doing there. That's a trading concept that they're using.
With it. But my one concern is that everybody, even it seems like most of the real big bears out there are looking for the market to rally into the end of the year, and that the big problems are only going to happen next year. So, and you see with the VIX down below 20 yesterday, it did bounce slightly back above it. You see that at least on a short-term basis, there's a lot of complacency out there. Again, a lot of bears out there, intermediate term, but short-term, there's a lot of complacency. So I'm not so sure we're going to get that rally.
Matt, I enjoyed.
So far, that's held true. It didn't look like, at least so far. Again, we still got another. What do we got? A week plus to go there. But so far, I guess almost 2 weeks. Anyways, so far, yeah, it hadn't done well at all here. So let's keep going.
This morning, you really took a deep dive into banks and various bank stocks. Now, you had JP Morgan CEO Jamie Dimon out this morning warning again about another potential recession. How do those bank stocks do if we get a recession next year?
Yeah, I mean, these bank stocks are not expensive. In fact, many of them are very cheap. But a lot of people compare to, remember at the beginning of the year, they said, hey, the market's very, very expensive, but don't worry because it's not like it was in 2000. And it's like, well, you don't have to be the most overexpensive, the most overvalued ever for the market to go down. And sure enough, it went down.
Yeah, that's actually a great point there, guys. Just because it's not as overvalued as it was in 2000 doesn't mean it wasn't overvalued in general. So, great point there. Something a lot of people forget. Everybody wants to compare it to 2008 or 2000 or this, this time, that time, 1972, I don't know, 1942, whatever. It gets kind of wild out there with some of the stuff. But anyways, great point there that, hey, you don't have to be as overvalued as you were in 2000. I know most of you guys weren't investing. Some of you guys were, a lot of you guys weren't. That was my first foray. It was not early 90s. Late 90s was my first foray into stocks during that time frame. And I can tell you right now, it was, we think through the EV boom and some of the other booms that we've had, recently here, and they are comically small and comically didn't get as overvalued, and they were ridiculously overvalued. Don't get me wrong, but when you compare it to 2000, the tech bubble, not even in the same ballpark there in terms of overvalued, in terms of the euphoria and ridiculousness that we saw kind of with all those EV players back then. So just kind of things to keep in mind. It doesn't have to go to that level, which was an extreme upon extremes, for the market to be overvalued and come down.
The bank stocks, people are saying this is not 2008 all over again. Well, that's great, but that was kind of the worst time in the banks since the Great Depression. So it doesn't have to be that bad for the stocks to come down. I'm not looking for a big problem, but recessions are not good for banks. And of course, the yield curve, when you have short-term rates higher than long-term rates, their net interest margins are going to be pinched. And so again, that's and you look at the way the group is starting to roll over a little bit. I'm worried about the stock on a technical basis as well.
Yeah, that's an interesting point there. So when we looked at the banks specifically, I own a few banks, JP Morgan, Goldman Sachs specifically are the big banks that I own. I wasn't touching them at this level in the first place. But then as they kind of, for whatever reason, Wall Street beat them down. JP Morgan at one point in time was at risk of going under $100. Now it's sitting at 128, 130, somewhere right up in there and such. So yeah, in terms of, the way I kind of view the market, it's kind of overvalued, undervalued. That's why I don't buy when they're overvalued. And times like right now, you want to definitely make sure you are buying in that undervalued territory. Doesn't mean it can't go lower. Of course it can. Nobody knows where the bottom is. There's so many people out there guessing this is the bottom, that's the bottom, this number, that number, all that good stuff like that. This chart says this. Hey, plug it in this formula here, plug it in my calculator there, all that sort of stuff like that. That's all stuff that you basically just got to ignore and get out of your head. Just get a valuation. When it goes undervalued and really undervalued, you go ahead and buy. Do I think JP Morgan could dip down below 100? Of course it could. Nobody knows. But I feel fairly good right now having bought shares at around $100 that, I'm sitting pretty with my JP Morgan shares. And then if it does come back down and it does have another, leg down, that's a big move in a bank to go from 130 down to 100 or below 100 or whatever the case is. But those are all signals to buy. Kind of like you said, this isn't 2008. The banks aren't melting down because there's actually no liquidity in the entire financial system. All sorts of the other craziness. We're not. This isn't the video to get into that here. We can do that at some point in time later on. This isn't that time, just like it isn't overvalued like it was in 2000. But it doesn't mean that some money can't come off the table in the meantime. So kind of keep that in mind as you're kind of working through these things.
Matt, when you talk about expensive, one of the other reasons that you're not that optimistic about stocks overall is that you think they're still too expensive. If you look at the S&P 500, and you wrote some interesting observations about what we've seen in the past before we can exit a bear market, where the S&P 500 PE typically is.
Right. It's the one thing is that we have all these different indicators of where's the market bottom going to be, and has inflation peaked, and stuff like that. Those are interesting comments. But the one thing that has an absolutely perfect record is valuations. Every single bear market. Now, not every bear market has had a recession since World War II, but every bear market.
That's why I harp so hard on valuations, guys. That's a perfect example right there. And understand when you're looking at an index like the S&P. Just because, tech stocks, your Tesla, for example, has fallen all that much. A lot of the S&P is a lot of these, I like to call them old man type stocks that are still overvalued. A lot of those dividend plays, a lot of those other stocks like that are still overvalued. I mean, we got Coke trading. I haven't looked lately, but last time I looked, it was trading at a PE like 30. It's ridiculous. It's just, that's kind of where, the flight to safety kind of goes. So when I hear something like the S&P's got to fall next year in order to make that, I believe that, but I don't think it's going to be like, okay, let's say they need to come down. It's going to take a, 20%, 30% correction to get them down, get the levels down to that PE of, 16, 18, whatever the heck the average is, or to kind of hit that undervalued territory to kind of create that scenario to where, hey, now we can pull out of this bear market. That doesn't necessarily mean that, a stock like, Google is going to fall another 30% to get there. It's just there's a lot of other stocks that are going to drag the index down while other stocks are going to rise within that index just the same exact way. The indexes, especially look at something like the Dow that's fallen the least because it's full of old man type stocks that just haven't fallen yet. But then you look at something like the Russell and it's completely cratered in comparison, or the NASDAQ, it's completely cratered in comparison. So just because the Dow or the S&P needs to, drop a little bit more and PEs need to, those valuations need to come more in line, either through the stock price coming down or revenues or, revenues earnings slowing. Doesn't matter which way they get there, but the point is it still needs to get there. And a lot of the stocks that are kind of propping it up tend to be those older man type stocks, those slow moving type, dividend plays, stuff like that that's holding it up there. So kind of keep that in mind when they're talking about that. Don't immediately go to your small cap stock that I own, your Palantir, for example, and think, oh my gosh, it's gonna fall 50% if that's gonna fall 20% in order to do that. A lot of the money's already been taken out of a stock like Palantir. Doesn't mean it can't happen. It could, of course. But a lot of times I think that's kind of that last shoe that everybody's waiting to drop is kind of even stocks like Apple. It's my favorite, but it needs to drop more. It's still in a little bit of, kind of fair valued or overvalued territory. If you're being honest, actually, I think the last time I looked, it's still in a little bit of overvalued territory there. So you got to kind of keep that in mind that, hey, until some of those stocks like that kind of drop, we haven't had a real crash across the board and a real correction in the overall stock market that's going on there. So those are just kind of things to keep in mind as he makes that point. So it's actually a great point there.
Especially every bear market that's also had a recession, has not bottomed until we got to at least a little bit below 15 times earnings. In other words, got cheap. We
15.
never stop
There we go.
at fairly valued. We always go to undervalued. And it was given how overbought and how overvalued we had at the beginning of this year, the chances are that we'll swing even further to the undervalued side before we bottom out. And
Hey, that's great news to my ears. I love it when stuff goes undervalued, then super undervalued. That's my favorite time to buy. That is when wealth is built. Those are opportunities that don't come along all that often. It's not often that the S&P trades at a significant undervalued territory. Yeah, sure, it kind of bobs between overvalued, undervalued. Now, again, in mind, I'm not buying the S&P. I don't care. I don't care what the S&P does. I care about what my individual stocks do. However, it is kind of an indicator for you to look at and go, hey, that may mean that some of the stocks that I'm looking to buying or kind of hitting that undervalued territory there. So again, I'm an individual stock investor, so I don't buy indexes. But if you are looking to add an S&P, some people like to do that, right? They pick half my stocks I'm going to pick. The other half I'm just going to put in an index fund. Kind of keep in mind, if you're looking to do that with that index fund, historically where stuff goes. Again, nothing's guaranteed. It does how far undervalued, who freaking knows? Again, there's all kinds of people out there guessing, so I'm sure you can just pull up somebody else's YouTube video and they're guessing. I'm not about to try to figure out a guess because it's strictly a guess. I guess I could change it 47 times, then I'll eventually be right. Then I can make a video pointing to that video saying how I was right. I don't know, whatever, guys. But anyways, back on track here. Let's get back to the video.
If earnings are going to come down, I mean, right now the market's trading at 18 times forward earnings and 20 times trailing earnings. If those earnings are going to have to, estimates are going to have to come down, which I think they are, that means we even have further to go. So the thing is, people are worried too much about what's the economy going to go further down the road? Yes, we always want to concentrate on that. But if the stock market is well above what the economy is going to be 6 months down the road, it's got to fall, even if we don't hit a recessionary time frame.
Matt, while we've got you, I want to just briefly touch on crypto here because you've been tracking the.
Basically, just go back to fair value is what he's saying. We got to at least get back to fair value at some point in time, especially with the Fed raising hikes and just the economy slowing down in general. We should probably hit at least fair value. Yeah. So I mean, in terms of crypto, I don't talk about it a lot because it's just not. I'm not an investor in it the way a lot of other folks are. I'm not sure I'm buying coins and everything else. I would say it differs from the tech bubble in the fact that at least as the tech bubble popped, those are stocks and they're businesses, and that is completely different than. It was talking about the internet. The internet at the time was new and didn't know what the heck was going to happen with it. However, we were talking about companies and stocks of companies that were doing things on the internet or using the internet in order to make business and such. That's a little bit different than something that is completely unregulated all the way around in the first place. It's not like you can buy stock in Bitcoin, you buy Bitcoin. Of course you can buy Coinbase and some other companies like that. But in general, when we're talking crypto, we're talking about something that nobody knows what the regulation is going to look like. Nobody knows what's going to survive, what's not. The government could easily stomp out crypto altogether, despite the fact crypto fans don't like to hear that. Sorry, guys, that's the facts. It's a stroke of a pen. Crypto, it'll still be out there, but the fact is it won't be worth anything at that stage if nobody's allowed to transact business in the United States for that, or companies aren't allowed to transact in it, or whatever the case is like that. So just some things to keep in mind there with crypto as it goes, because I don't cover it a whole lot. So there you go. There's my crypto take for the next year. Probably won't talk about it again in the meantime. But in regards to this, in terms of the market falling, understand that as an individual stock investor, I don't care what the S&P does. Now, do I think the S&P can revisit the lows again? Yeah, they can. Of course they can. The indexes themselves, hey, we still got a long ways to go, right? We still don't know how far the Fed's going to tighten, what the impact of those tightenings is going to be. We're just now at the beginning stages of seeing what the effects of the tightening are on the very first rate hikes, much less all the subsequent ones that have been, unprecedented in terms of how quickly and how big they've been. So those are some things that still have to play out. We still need to see what happens with those, and then how does that affect the stocks? Now, of course, in terms of the market, you assume, hey, we got a recession, earnings are going to start to come down. Some companies have adjusted for next year and have already adjusted for a recession. You see some companies just now starting to kind of make adjustments. Everybody keeps talking about mass layoffs. It's like, no, everybody's right sizing for a slowing economy. During boom times, they always overhire and then they always right size. Some of these companies right size every year, but that doesn't make for a good headline if you say they do it every year. However, it does if they're going to lay off 8% of their workforce. Hey, now it makes for a scary headline, these mass layoffs at these places that they do every year. But anyways, I just ruined a video for somebody. I'm sorry ahead of time. But the point is when you're looking at that, yeah, it could absolutely fall down. Does it make a new low? We saw, June to October, it was the same sort of deal, right? Hey, June, low. October made, a new low. It wasn't a substantial new low. However, it was a new low. And some stocks didn't make new lows during that time. Some stocks were still riding high off that June low, and some stocks obviously made new lows. So we'll kind of see what the mix of stocks is going around, and kind of like we talked about here in this video. Hey, I could see some of those old man stocks coming down and creating a new low in the S&P 500. However, some of the stocks that hit a low in October and in June doing a lot better and actually increasing during that time frame. So don't be surprised if you see stuff like that, because the narrative is going to be negative overall. It doesn't matter. That's where the narrative is going to be. But again, as an individual investor, what I'm doing is I'm watching my stocks and I'm watching those earnings calls specifically with those stocks to kind of see where they go. So does the market fall next year? Probably so. Does the market end flat? Does it end up negative territory? I have no freaking clue. The only thing I know is that if that happens and if my stocks are also negative, it means I was able to add all the time through that entire year, or multiple times through that entire year, at a better price, and I will make more money in the long run. Remember, my mindset is 3 to 5 years out. I'm looking out next year and kind of going, okay, well, if my stocks do go down, great. I will continue to buy on the same schedule I've been continuing to buy this year on, and continue to buy next year as well. And again, this is how long-term wealth is built. So hopefully you enjoyed the video, guys. Make sure you subscribe if you're not subscribed, and click this video here if you want to see what stocks I'm buying during this downturn, and click here for my exact plan for what I'm doing during this little downturn and recession. So thanks for watching, and we'll see you in the next one.